Hi guys, today we are going to learn about debits and credits. So in this video, we will try to understand as to when we will have a debit entry and as to when we will have a credit entry. So let's begin with the basic accounting equation, which is assets equal capital plus liabilities. Whenever there is an increase in assets, so just remember it like this: if there is an increase in assets, it's debit. If there is an increase in capital or liabilities, it's credit. What if there is a decrease? Then it's the exact opposite. If there is a decrease in assets, it's credited. Decrease in capital or liabilities, it will be debited. Now when doing questions, we will have to understand the expanded version of this equation. So let's move on to that now. The basic accounting equation is assets equal capital plus liabilities. But this capital consists of several elements. Capital includes owner's contribution minus drawings plus profit. And how do we calculate profit? Profit is income minus expenses. Taking all this into account, we can write the equation like this. Then we can write the equation like this: assets equal owner's contribution minus drawings plus income minus expenses plus liabilities. To make work easier, let's rearrange this equation. Then it would appear like this: assets plus drawings plus expenses equal owner's contribution plus income plus liabilities. Same case as before. Previously, it was a debit if assets increase, a credit when liabilities and capital increase. Just like that, if there is an increase in this side of the equation, it's a debit. And if there is an increase in this side of the equation, it's a credit. In case of a decrease, it will be credit and debit, like that. So let's move on to some questions and see how we tackle different scenarios. Here we have some questions. When we get questions like this, the first step is to understand the accounts involved. Is it capital? Is it cash? Is it a motor vehicle? Likewise. Second step is to understand the category that each account falls under. And then to see if it has been an increase or decrease. Then we will be able to easily classify as to what account is debited and what is credited. Owner, which means it's related to capital. Invested money, so that is cash. Cash is an asset. Capital is, in this case, what we identified as owner's contribution. So when the owner invests money, owner's contribution increases. And cash in the business also increase. So cash increasing is an asset increasing, so the account debited will be cash. Owner's contribution increasing, that's the other side of the equation, that is increasing. Then it's a credit. owner's contribution. So let's say capital here. Next one, owner contributed personal vehicle worth 2000. So the owner again, so it's again owner's contribution. It's a personal vehicle, so vehicle account. Vehicle account is an asset. When the owner introduces a motor vehicle, yes, owner's contribution increases. So when capital increase, it's a credit. I'll say capital. Motor vehicle is introduced, assets increase. So here we have the motor vehicle account being debited. I'll say vehicle. Next question. Bought machinery for cash worth 500. Now, machinery is an asset account, right? Cash is also an asset account. When machinery is bought, the amount of machinery in the business increase, so the asset level will increase, which means we debit machinery. So machinery is debited. Now cash, we pay by cash. So the cash held in the organization will decrease in this case. Then when assets decrease, it's a credit. Do you see how every transaction has both a debit entry and a credit entry? So here it's cash account that is credited. Then purchased goods paying by check. Remember, purchases is considered as an expense, right? So you purchased goods and the account is an expense account. Remember, an expense will be in the debit side. If there is an expense, it's debited. So the account debited will be purchases. Then what is credited? You're paying by check. That means you use the money in the bank account to pay for the purchase. Bank is the account involved here. Bank. And bank is an asset which is decreasing. So asset decreasing will be a credit. So I'll say bank here. Bank is credit. Question 5 says sold goods for cash $100. Sold goods for cash. Sale is an income. It's an income. An income is considered as a credit entry. So here we have sales. And we sell for cash, which means we gain money, and cash is an asset. Cash is an asset which is increasing because we get money. Asset increasing is a debit. So here we say cash. Question 6. Purchased goods on credit. Now it's a different case. Purchased goods on credit. That means we buy goods now but we pay later. So in such a case, the third party involved is a trade payable. We will have to pay him one day, and he's also called a creditor, which is nothing but a liability for the organization. So when you buy goods on credit, the liability increases because someday we will have to pay. We are obliged. So liability increasing is a credit. Trade payables. or creditors you can say. And it's a purchase, which is, as we discussed before, a purchase is an expense, and that is a debit entry, purchases. Next case, sold goods on credit. Now here what's happening is we are selling goods to a customer and the customer says, okay, I will pay later. So it will lead to a future economic benefit. Someday I will get my money. That is an asset. And the asset account here is the debtor or the trade receivable account. So asset increasing is a debit. Trade receivable. And it's a sale. Sales are considered as income. Income account is credited. Sales. Next one. Owner took cash from business, $20. Now it's the owner involved, but owner takes cash. And it's cash. Cash is an asset. But when the owner takes cash, the amount of cash in the business will decrease. So asset decreasing is credit. The asset account is cash. Now, owner taking money or inventory for his use is considered as drawings. Drawings is a debit. So drawings come here. Last question, borrowed a loan from bank, $1,000. Borrowing a loan is a liability because we have an obligation to pay the bank one day in the future. So it's a liability increasing, which is a credit. So the liability account here is bank loan. And when you borrow money from the bank, cash held within the business will increase. And cash is an asset which is increasing. So that's debit. Cash. Now remember, as seen in this question, every transaction has a debit entry and a credit entry.